efficient inefficiency. Bit of a oxymoron, but what am I talking about here? Let's examine in this video. Please like and comment on the video below. That will allow me to produce better quality videos and more of them in the future. If you're interested in learning to trade successfully on sports, then why not visit the BetAngel Academy, where we have more detailed videos. So I've been thinking about doing a video on this for some time, but I've been struggling to figure out how to explain it. And I was listening to a book, and I'm trying to remember what the book is called. What is the book called? Superforecasting, that was it. I knew it would come to me eventually. And I'm quite enjoying the book, actually. It's a pleasant book to listen to, and it contains lots of interesting information, and it resonates with other books that I've read, and it resonates with me as well. I'm thinking, aha, I knew it. I knew I was right. But what am I talking about here? Well, if you go to an academic, they'll say to you that the market's deeply efficient. So I was just looking for my mouse there. They will say that the market's deeply efficient. And what they mean by that is basically, if you bet or trade anything within the market, it's just perfectly efficient, and there's no way that you can make money. And people have said that to me repeatedly, time and 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 time again through my entire career, and they've always been wrong. And you know, how do I know that they've been wrong? Because I've always bet against it, and I've always ended up. So originally it was on the football pools. Then it was a little bit in gambling markets. It's been in financial markets, where I've learned a lot about how markets can be efficient and inefficient at the same time. And then with, you know, the bulk of what I've done in this particular career, whether it's betting, trading, or variants in between all of those, consistently I've been able to prove people wrong. How? Well, you know, I've been going now for such a huge length of time. I've traded nearly 200,000 markets. If this was just luck, I am the luckiest person to have ever existed on planet Earth, probably the universe, because it's impossible to have gone that long and still have made money. You would have lost so much money now if there would have been no edge in anything that you would have done. So the interesting thing is this throws up two elements to the market, because if you look at any particular market, you get a bell curve. So the bell curve is drawn from the middle outwards, and on one side you have an extreme event that's positive, and on the other side you have an extreme event that's negative, or you know, however you wish to cut the bell curve. It will have different shapes and sizes, and it may have a fat tail and stuff like that. But essentially what this is saying is, it's saying that all the information in the market is contained within that bell curve. The extreme event over here, the extreme event over there, and various grades in between. Now I can tell you on racing, when I first started with racing, I knew nothing about racing at all, and I started actively trading it, and trading was the thing that I did for ages and ages and ages. But over the years, the book percentage, the book over round, is gradually shrunk and shrunk and shrunk and shrunk and shrunk to the point where it's negligible now. So in an effort to generate commission, I started doing a betting strategy, and miraculously I accidentally turned that into an outright strategy on its own. But purely because when I was doing it at random, I realized that there was something going on. I could see there was a distortion in the market that shouldn't be there. And I started to gradually unpick and understand exactly what it was. But to do that, I had to understand racing a bit better and understand how the markets were priced and various other things. But basically you figure out that there's a certain level of noise within the market. And if you get a certain level of noise within the market, then that noise is sort of describes just changing opinion. However, every now and again the market goes above and below that noise. It's very similar in essence to the sort of thing that you would do if you were valuing a company. And if the price on a share is falling and falling and falling, but the fundamentals in the company are the same or rising, there comes a point at which it becomes value. And you find the same in a lot of the betting markets. So I can slice and dice the market several different ways to identify when that is likely to be occurring. It doesn't say that I'm going to get it right every time, because that's impossible. But generally you can sort of price the market and say, okay, I'm in a comfortable margin of safety here, and therefore I think this position is likely to pay off. Works on trading, works on gambling. And the thing about the gambling is, okay, you've got commission to pay, but if you're a higher rate commission payer on Betfair, it's an irrelevance anyway. So in fact one can help the other. That's how it came around to me. But I began to discover that, the description of the market, and I've always known this for ages, but the description of the market is false. People say it's very, very highly efficient and that pricing is very efficient, which is true. I can prove it's true and it's false. Very confusing. But you can see that the market generally is a fair representation of chance. So, but I've known for years that is not the case. So I can give you a really simple example here. If we put a bell curve up, then I can follow that with another bell curve. And you can see that this bell curve is slightly distorted. So this is a bias that I picked up in the market almost on day one of starting to use the market. I could see that there was a subtle difference within the market, the way it acted. And for years I couldn't describe it, but I eventually was able to describe it and able to quantify it. And it persists until today. So you can see that, hold on a second, the bell curve's perfect, but there's this bias in the market. So what's happening? Well, obviously people counteract the bias. I'm counteracting the bias. So that's making that bell curve nice and smooth, despite the fact that the bias exists. Because when it exists, when it occurs, I jump in and push the market back in the other direction. So reading this book, stroke listening to the book, because I don't tend to read, I listen to stuff on Audible when I'm on my bike. Listening to superforecasting, he came up with a description of how this can occur. So he was saying how they won a competition by using this theory as well, a prediction competition. But he was basically saying, okay, imagine you go to a village fete and they're going to slaughter a bull. And they're asking, to win the slaughtered bull or something, or a prize, you have to guess the weight of the bull when it's been slaughtered. I'm not sure why I used that example. It exists somewhere, or there's a reference to it at some point. It's like the jelly bean experiment in the wisdom of crowds. But so in that bell curve you get guesses of people that are, so for example you get the butcher from the next village who looks at it and thinks, oh yeah, that's about 2 tons, blah, 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 blah. And, he gives you a fairly accurate guess. But of course he's thinking, well, it could be, but it couldn't be because I don't know the bull. And, so he sort of says, well, I think it's going to be that, but I'll hedge my position a little bit. And then you get somebody guessing somewhere else that has some information. So maybe they were at the show last year and they figured out that it looks about the same. So you can see the whole of the bell curves are made up of good guesses, bad guesses, rough guesses, and they have this tendency to converge in the middle, which is why the wisdom of crowds work, because the average guess is pretty good. But some of these people definitely have an advantage over others, but they're counteracted by people on the other side of the bell curve, part cancelling out that information. And also you get people making silly guesses at either extreme as well. But the central guess is really quite accurate. And the individual guesses within the market can be quite good as well, but they're counteracted by people who just haven't got a bloody clue, basically. And you'll find that in the betting market and in the trading market as well. So what they did is their competition was run to forecast things, but they basically took the median guess, and if it was above a certain value, then they would skew it up slightly, because they theorized that if the people within the good guesses knew that there was additional information available, then they would probably, their confidence interval, their confidence within the prediction that they'd made would go up, and therefore the average would move slightly in that direction. So remarkably, they won a competition on that hypothesis, basically saying, if there's information within the market and it's guessing like at 70%, we're going to stick our guess in at 75 on the basis that the market seems to think that this event occurring is quite likely. And so we think that if they knew that they had decent information and they knew that they're on this side of the bell curve, they would probably have a little bit more confidence, therefore go a little bit higher. So yeah, they were sort of describing this mixture of information and how people appeared in different sides of the market with different guesses, and some were well informed and others weren't. But the average of that was generally quite good, but necessarily the people who had a little bit more knowledge were generally should have been probably slightly further to the right of the bell curve. That's what they sort of discovered. But I've noticed in racing markets and in a variety of different markets that the same biases occur. If you look at it from the top level, so if you say to me, hey Peter, what's the chance of the favourite winning this race? And is that price efficient? I'd probably go, yeah, it is pretty efficient. But if you introduce other characteristics and you say but this, but that, but criteria 1, 2, 3, 4 and 5, then I can slice it a little bit deeper look at the price and say, well, actually, I think that that's probably not value, or maybe you should lay that, or maybe you should back this. And remarkably, that plays out. You look at the bell curve, and the bell curve behaves exactly the way that you'd expect. You get extreme values over here and over here, and you also see that the median guess is quite good. But if you start putting a little bit more information into that, you shift yourself just to the right of that bell curve. I've seen it, I've put it into practice, and it works. But yeah, overall the market is very efficient. But if you take a really broad step back view and look at the market and measure in that respect, that's the result you're always going to get, because that is the wisdom of crowds, the discounting of information. But within that market, there are lots of smarter guesses and not so smart guesses. And if you can just slice it up and get access to a little bit more information and look at it in a more narrow focus, then you tend to find that there is value in there. I've been amazed that some of the biases that I've seen in the market have never disappeared, and that tells you that there's other things going on within the market as well, that is forcing the hand there. But also from a broad level perspective, you are reliant somewhat on the mechanism as well. So if liquidity collapsed on the exchange tomorrow, that would be a completely different issue, and maybe the characteristics of the market would change a little bit from there. So yeah, no, I hope that's been of some use to you. Within that beautiful description of efficiency, there are lots of little bits of information, and some of it's quite good, some of it is quite bad, but ultimately if you slice and go down to a narrower level within the market, then you'll tend to find that you end up slightly to the right of the bell curve, which is exactly where you want to be. So the market can be efficient and inefficient at almost exactly the same time. It just depends how you look at it.